Welcome to the weekly update, where we'll go over the action in the market for the week of October 21st through the 25th, and then we'll see how things look for the week of October 28th through November 1st. My goodness, it's already November. Well, after 6 straight up weeks, we ended up having a down week, with the S&P being down almost 1%. Probably not a real surprise after a really nice run up. We didn't go through the weak seasonality that we were expecting, or at least watching for, in September. And then October tends to turn more positive unless we have a crash or something. Well, unless something happens this week that's really, really crazy, the market's still looking positive overall. So to see a pullback, and that's all it's looking like right now, is a pullback. We're not necessarily in a decline. We're seeing mixed signals on the daily charts. There are some that are positive and some that are negative. On the daily side, when we're above the 20-period moving average, that's how I measure if we're positive or not, and we're still above that. We tested that level 2 times this week. We fell below it on Wednesday, and then we're able to close back above it. And then on Thursday, it marked the low for the day, and then we stayed above it on Friday. So at this point, there's been a successful test of the short-term trend. But we have other things inside of the market that are giving us some concerns. And if you want to learn more about that, please check out the daily videos. Before I get started, the daily videos are where I do my deep analysis and commentary. I know they're longer. I know I go through lots of charts. That's all by design. It's what I have found after decades of doing this, that's really what works, to get these subtle little changes that we can see. And so we can see things before they're happening and watch for them. Now, sometimes they don't work out. We just say, okay, let's watch for this, let's watch for that. And it doesn't come about that way, but at least we're watching what's going on. There is a PDF that's available in the description below this video. There are pivot points that I update every day on the YouTube community tab. And they are pivot points that last for the whole week. We're going to be switching over to a new month at the end of this week. And there are pivot points that only last for that particular day. So I update that each day as well. There is a private Facebook group, and there's not a lot of activity. I pretty much just post whenever a video gets uploaded, but I'm there. I keep that room open pretty much all the time. If you have any questions, if you want to say hello, if you want to join the group, if you belong to Facebook, you're more than welcome to do that. There's a link that will take you to the group below this video. Also, I really go through and watch YouTube and Rumble comments. I get rid of the crap comments. Now, I don't really mind if you agree or disagree with me on things, and I don't get a lot of comments on the videos because I don't really take a stand one way or the other. I let the charts speak for themselves. But I get rid of especially on Rumble, I'm getting all these things about these social media experts, and I have to go through 2 or 3 times every day and delete those comments. But I also post on Rumble as well, and sometimes I do have some uploading problems, but I'm on both platforms, and I do that to kind of have a backup in case one of the other platforms is not cooperating. I do have a thing called the SPXInvesting Program. It's up, it's going, it's free until the end of 2024. If you want to go and check that out, there's a link in the description below this video. Excuse me. There's also a link that will take you to a video. One of the benefits is you get immediate access. Right after I record the videos, folks on the website get to watch those right away. And that's the way these videos were designed, was to watch them just as soon as possible. If you have any questions or comments or whatever you want to talk about, here is an email address where I can be contacted. Also, as I mentioned, the daily video is the real foundation of the analysis that I do. This is just one of the weekly videos that I prepare. All right, let's go back and talk about this week's session. For the week, we were down 0.96% where the S&P. Volume is still below average, and that's been kind of a concern. It tends to be more negative when we're going up and we're below average with volume, where it tends to be more positive if we're going down and we're still below average with volume. And there could be some apprehension ahead of the election. We're just coming up about a week and a half away from that actually taking place. We are still positive. Now, we did see a bit of a pullback and we had a down week. And so we'll go through and look at some of these charts, and I will compare them to the daily charts as we go through them. We didn't really get much information about inflation this week. We're going to get some in the upcoming week, and we're going to have the big employment situation report coming out on Friday, November 1st. But interest rates were causing some problems for the stock market. We had the 10-year yield and all interest rates were going back up. And the market really wasn't paying attention to that for a while. Well, suddenly this week, once we got up around the 4.25% level with the 10-year yield, suddenly the stock market kind of freaked out. And then we started coming down a little bit on Thursday, but then interest rates started going back up on Friday. And that we had a really nice gain in Friday's session, but then we gave all that up and ended up closing negative on the day. And then there's geopolitical things going on. Specifically, as I record this, there's news coming out that Israel has attacked different places in Iran. That's pretty much all I know right now. I haven't had a chance to really check that out at the time I record this. And of course, we have an election coming up in the US, and we'll have to see if something crazy happens with all of that. As far as our trend, it's still a weakening trend, meaning we're below the moving average. And I will show you this chart, but we're still positive. The green line is above the red line. So just some bullet points to take away from the week. We did end down with stocks after the S&P had 6 up weeks in a row. And then to this point, any declines that we're seeing, it just appears to be a normal pullback. We haven't necessarily switched over negative. We're watching that 20-period moving average on the daily charts. If we close below that, that's going to turn the short-term trend to negative. So far, we've tested it a couple of times, as I said earlier, and the market has held up. Now, that could change at any time. So if you're watching things throughout the week, you might want to keep an eye on the 20-period moving average. Interest rates were up, and this ended up pressuring stocks. Where a week ago, we were at 4.07% with the 10-year yield. After Friday, we were at 4.23%. We actually got up into that 4.25 area and even climbed above that intraday. And that's when the market went, well, wait a minute here. Let's freak out a little bit over this. And the dollar, even though it's still in a downtrend, has really been strong lately. And the stock market likes a weaker dollar because that helps for exchange rates, and conversion rates are more advantageous. And the dollar going up did put some pressure on stocks. What held together fairly well were the mega caps and the semiconductors, and that's encouraging, especially in Friday's session. We saw these areas, which are the buy low, sell high, the high-flying stocks that everybody really likes, we saw them perform quite well in Friday's session. They were actually up where the rest of the market ended up being down. If that can continue, that would be positive for the market. In earnings, there's kind of case-by-case basis. What we've seen a few times throughout the past week, as earnings season is in full gear right now, is that a company will come out with a report. It'll be great. They'll even say things look good into the future. Well, it's kind of a buy the rumor, sell the news type of a thing where stock price may go up, and then once the earnings are reported, even if it's great, they sell. And that can put some pressure on stocks when that kind of thing happens. So for the week, the Dow was down 2.7%. It was just a week ago that the Dow set an all-time high, but it got hit by some earnings reports that came out throughout the week. And it's only 30 stocks in the Dow. So if one or two of those stocks are not having a good day, that can really drag the Dow down, and that's what happened. The NASDAQ was up. Now, it held up better, and this is tech. And so this is encouraging. Even when we had down days with the S&P, the NASDAQ and NASDAQ 100 still had small gains. Not by very much, but they were still up. So that's kind of a positive thing hanging out in the background. We were up 0.2% with the NASDAQ. We were down just about 1% with the S&P. And small caps, after going up and giving everybody hope, well, they were down 3% this week. I've been showing this for a year and a half now. This is just a chart how inflation, we still seem to be going down like this blue line is here, but just be aware, things can change after that. The economy can change, something can happen, some kind of geopolitical event, and that could kick inflation into gear, or we might keep going sideways, or we might continue to fall with inflation. We'll have to see how that plays out. That's just something to keep in the back of your mind. because people tend to think that the way things are right now is the way they're always going to be. Well, that's not how things go in the stock market. There's always changes going on. The market always finds something to freak out about. Right now, we're going through a period of time after we saw inflation really going up. Now, inflation has been coming down. This also is a little bit of a concern and why stocks started to react to interest rates going up. We're up in the 4.24% area with the 10-year yield. Well, when we go above 4.02%, that's where it starts to bite into corporate profits. And this is based on some research put out by Renmac, who I found this chart on Twitter like well over a year ago. We don't have this chart updated yet. This will be updated when I do next week's weekly video. This is updated when the employment situation report comes out. So the takeaway from this chart, as I seem to say every week, is that whether you're Morgan Stanley or looking out into the future, we're seeing everything going up and to the right as far as earnings, and that's what drives stock prices. Then we look at the distribution of the S&P 500 annualized. It's the 10-year return from, they're expecting it to be from 2024 right now, going out 10 years from now. And this is all probability. This is all, we don't know really what's going to happen, but this would just be, okay, if we stick to about normal, we would be right around 3% here. But this is all probability and it's subject to change very easily. Then long-term outperformance of the mid caps against the large caps and small caps. This is just showing how the mid caps have really been doing quite well. This is the S&P 400. They're just coming off of setting a recent all-time high. And then we have the equal weight large caps. That's another index that we follow. That's been doing a lot better. So to see the equal weighted version and the mid caps doing well is good. And then here is the S&P. And then small caps are really lagging, but these tend to be cheaper companies. Sometimes their stock prices are lower, and that's really enticing for a lot of investors. All right, FactSet, they're busy right now because we're right in the middle of earnings. The first blog post was, are the Magnificent Seven companies top contributors to earnings growth for the S&P in the third quarter? Well, yeah, it kind of looks that way. You look at all these together, they're really helping out with a lot of the earnings. And then it's probably hard to see because this is pretty small. This breaks it down. These are the companies that have reported and how much of an impact. This is Alphabet, which is Google. We have, is that Micron Technology, NVIDIA, Pfizer, and Moderna here. A lot of big drug companies are in this as well. They're not doing so good right now. And then this is looking out, okay, what are they looking at right now and how are the Magnificent Seven outperforming the rest of the market, either right now or going off into the future? And then how are things going with earnings updates? At the time Friday when we closed, 37% of the S&P 500 companies have reported. 75% of those that did report, they've been above their estimates. And like I said, you might have just a stellar earnings report, but then you see a sell-off because it's like buy the rumor, sell the news. So when you take all of this together, as of right now, we're 5.7 above estimates. So that's pretty healthy for the time being. And this will get adjusted every week until we get through earnings season. All right, so here's the intraday chart where we did okay on Monday. We ended up opening higher, but then boom, we came down. But this happened so quick and we hit support here that we actually fell below the 20-period moving average. But no, I don't think we did on Monday. That was here on Wednesday. That's when we fell below it. But we came down, and then this looked like it could be pretty solid, where we found a good base of support, and then we saw some buying going up after that. We were still down on the day, but we really recovered off of the losses. Then on Tuesday, we had a pretty good day where we gapped lower, and then things went higher on that day. That was still looking pretty positive. The most negative day was Wednesday, where we gapped lower, and you can see here a couple of times people were trying to buy the dip, and it just wasn't working out. We came all the way down here. We got close to the 5,800 level again, and we were able to bounce up off of that. And at the time, I was pointing that out that, hey, maybe we found some good support, and look at this solid upward move going into the end of that day. Maybe it'll carry over into Thursday. Well, it didn't. We did have a gap higher open, but then we just chopped sideways after seeing a little bit of a dip down and then coming right back up. It was a really yawner of a day. And then Friday, it looked like, okay, maybe we'll get something really going. We gapped higher to the upside. We went up. And right about at this point is when the 10-year yield started hitting 4.25%. And it also bounced off of its 200-day moving average. And it was going down, and then it bounced up off of that, and yields started to go back up. And this time, the market paid attention to that, and we ended up selling off. We dropped all the way down. We actually went negative, tried to go positive near the end of the day, but then went negative going into the close. We were slightly down in Friday's session. So you could look at all of this together, and there's some positive things. There's some potentially negative things as well. But for right now, the market is holding up. So for the week, we ended up, and these are just the 5 trading days. All of the indexes that we follow were negative, with the Dow being down the most, and then the mid caps were down after that. But everything ended up being negative. Year to date, we still have all of the indexes being positive, with the small caps still lagging behind. For the sectors, and I sort this when we had a down week, what was down the most? Materials, and this tends to be driven more by what's going on in the economy. And then healthcare, that's more of a defensive area. Industrials, that's all. If we're doing better economically, then they tend to do well. And these areas, all 3 of these have had pretty good runs. And the financial sector is still really strong, but we saw some profit taking. So that's why they were down in the week. We're watching utilities because this tends to be more defensive, but we're wondering if it's kind of morphing into more of a growth area because of the whole green thing and electric vehicles and all the electricity that's needed. Real estate was down. They don't really like interest rates going back up. The only sector that ended up being positive for the week was discretionary, and that really was led by Tesla. They had a really good earnings report and didn't sell off. They actually were up almost 22% after their earnings came out. But these other areas, communication, tech, and discretionary, these are the growth areas. And even though they were down, they weren't down as much. So this is kind of encouraging if you're more positive on the S&P. Then I rank this a different way, looking at the scooter score, where we have utilities and real estate as well as the financial sector. They're all in the 90s. These are the strongest areas right now. The weakest area still continues to be the energy sector. So looking at the sectors, this is just for the 5 trading days of the week, pretty much split down the middle here, where we had discretionary doing the best. And a lot of that was Tesla. And the same day that Tesla was up, Amazon was also up. That's part of the discretionary sector. So this was an area, and that we want to see this doing well. If we're more positive on the S&P, real estate still ended up being up for the week, where we had materials, industrials. There was some profit taking here after they had been doing a lot better. Going back to the beginning of the year, we still have utilities, communication, and financials. They're positive. All the other sectors, starting with tech, they're pretty much flat, the way I measure it here. And then we have healthcare, energy, materials. They're still down year to date. Then we look at this a little different way, looking at the relative rotation graph, where we have real estate, which had been stronger, and it's still green, and it's up in the plus plus area here in this box, but it's really been coming down as interest rates have been going up. We've also seen utilities. They're not as, they saw some profit taken recently, and they had a really good run up as well. Energy is probably the weakest sector right now. We're seeing an improvement here with tech. That's XLK, where it's blue and it's actually turning more positive. We're seeing materials looking a little bit better. And then we have XLI, which are industrials, and XLF, which are the financials. They're looking a little bit better as well. XLP, that's staples. And these, think of toilet paper and toothpaste, okay? And we want to see XLC doing better here. That would be communication, and XLV is healthcare. So kind of, it looks like a bunch of worms crawling all across here. And then this presents it more as in a spreadsheet type of a manner, where real estate, utilities, financials, even though they're seeing some weakness right now, they're still the stronger areas of the market. And we like discretionary doing better. It had been disappointing for a lot of 2024. Neutral areas would be tech and materials, where the negative areas would be energy, healthcare, another defensive area. And even though communication is still one of the stronger areas, it hasn't been doing well when you look at it over the last year. Then we look at just the different indexes where utilities had been really strong and boom, just really seeing some weakness here. We're seeing a little bit of improvement, but still negative with the S&P and the S&P 100. The small caps, they're saw some profit taking there, so they're looking weaker. The NASDAQ 100 is still not looking all that strong when you look at it over the last year, seeing a little bit of improvement with the transports and the mid caps. Okay, and here's the spreadsheet with the transports, mid caps, and the Dow Jones Composite looking the best. More neutral are utilities, the S&P 100, and the S&P 500, and negative would be the NASDAQ 100. We want this to be doing better if we're more positive on the S&P, and it would be nice. A lot of people have been expecting small caps to do better, but they seem to do really well for a few days and then give all those gains back. Sentiment, we did get the latest reading from Investors Intelligence, pretty much neutral right now. If we get above the black line or below this other black line, that's when we really pay attention to this. So we're not seeing anything one way or the other. Looking a little more positive here. Now, the sentiment indicators that I look at, I go over in other videos. We were extreme a week ago, extreme positive. So it's not really surprising that we've seen the market a bit under pressure. Well, this sentiment indicator, it's still below this dashed line. It still has more room to go up, and it could actually show some improvement. Then just for kicks, we've seen a real shift here lately. This is predictit.org, one of the betting sites out there. And we've seen a big change, and it's even changed more than that since I took this screenshot, but that's really changed quite a bit. Okay, here is the fear and greed index where we were at 75. Now we're still positive because we're in this green area, but we have to look at the next chart to see the context. We got up here looking a little too positive, and now we've been coming down. So the context of this is sentiment is actually decreasing right now, even though we're still positive. The active asset managers not getting any kind of an extreme reading right now. They were actually down a little bit in the latest reading. We came in at 79.13. And this chart and the previous chart are the same thing. I just show them in different ways. And we're back above 20 now with the VIX. We did get back below it there for a while, but with Friday's sell-off later in the day, the VIX is going back up and we're above 20, and that's when we see negative annualized returns. So we're above 20 both with the line chart as well as the bar chart. And this is updated now. We're trying to track the red line. That's what the VIX has actually been doing with these lighter lines here. That's historically what has happened. Not really matching up all that close with what historically has taken place. Still positive here. We have the black line going down. That means the tech sector is outperforming cash. Right X bear bull ratio coming off of being extreme positive here. Now, this is 1 day late, so this is as of Thursday. So we'll have to see if this ends up going up. But folks are still more bullish than bearish right now. They use Right X mutual funds. The Ulcer index is still below the moving average. Not seeing any real fear there. I'm not seeing any real concerns. When we look at the spread between risky and not as risky bonds, we're still going down here. And just to show you that, this is an inverted version of that chart we just looked at. We came up or down, I should say here, a little bit in Friday's session, but overall we're getting a very low reading, which here would mean a very high reading. If this really goes down, that's when we get concerned. And it's not going down with any real magnitude. The latest reading from the American Association of Individual Investors, they really dropped down. They're at 7.8 right now, but the 50-week moving average continues to go up. The ratio of the VIX to the 3-month average of the VIX is still going up. That means that the shorter term VIX is going up more than the average of the VIX. And that's what we've been seeing. Even with the S&P going up for the most part, the VIX has still been going up, and we've been getting really high readings, and that's why we're seeing this red line going up. But when we look at this longer term with the 253-day moving average of the equity put call ratio, this continues to go down, and that tends to be positive for stocks. The economy, we're still under the black line with the financial conditions index, so we're okay there. The latest reading of GDP now, a little bit over 3%, about 3.25%, according to this. The top and bottom forecasts have it just under 3% to the upside and just under 2% here to the downside. GDP still looks solid going out. Now we're going to get GDP this week coming up, and that could be pretty influential. It'll be the first time we're seeing this particular number. This will be updated a week from now with the real-time SOM rule recession indicator. We got up to 57. After the last reading, we're at 0.5 or 50. We're going to see if that's coming down or if that's going up. We get concerned when we go above the red line, which means that we could go into a recession. Also, the U.S. recession probability still getting a very low reading here, but this is almost a month old now. This is a bigger blow up of that same chart where we're above the black line, but still below the red line. And this is updated once a quarter, the Brave Butters Kelly leading index. Still not really giving us all that much concern. We were a little nervous when this was really going up, but lately it's been coming down. Inflation, we'll get the core PCE in Fridays. I believe it's either Thursday or Friday. We're going to be getting that, so these inflation numbers will adjust. And as far as the Fed, there's a 95.1% chance that they're going to cut rates 25 basis points at the next meeting. So we're at 4 3/4 to 5 right now. They think that we're going to be at 4.5 to 4 3/4 then. And that's pretty much locked in right now and hasn't really changed. This is right now. This is a day ago, a week ago. It did change about a month ago, but we haven't seen all that much of a change lately. Looking out to the December meeting, there's a 74.6% chance that they're going to cut another 25 basis points so that we'll be at 4 1/4 to 4.5 after that meeting. And that's pretty much locked in right now. But this could always change. And there's still a lot of things. We've got an election. We've got tons of economic reports that'll be coming out between now and December 18th. So this could fluctuate one way or the other. And I always make this comment here. We've got the Fed balance sheet. It looks like it's going down, but the number's going up over here. And we keep an eye on the year-over-year change. We're going up with this chart and down with this number. Only a government chart can do that. And we're watching this, not really seeing anything all that out of the ordinary with the overnight reverse repurchase agreements. We just look for some crazy movement that really hasn't been happening lately. And this mainly applies to the banks. So if the banks are starting to run into trouble, this is when we see this chart become quite active. Breadth is still looking positive here. And we were actually up with breadth in Friday's session, even though price was down, and that could be positive for the daily charts. We're still looking good here with the weekly chart based on price, and we're just coming off setting a high here based on volume. So really no technical damage when we look internally in the S&P here. And we did see a contraction of the new highs this past week. We're going sideways with the 4-week, and we're declining just a little bit with the 10-week. It's not that we're seeing a real decline here. It's just that we're seeing a drop-off in the new highs, but really no expansion of the new lows. And this had become quite extreme here on the weekly chart. We've actually turned negative on the daily chart. The blue line's below 0. But this was getting pretty extreme in the short term, so to see this coming down is not really a surprise. Accumulation distribution still looking positive, even though it rolled over a little bit. We're still above an advancing moving average. And we're seeing pretty much that same thing on the daily chart too. So daily version, we're still looking positive here, even though there was a little bit of weakness after Friday. We're also seeing a little bit of a downturn here, but we're above the moving average. As far as our trend, this is where I say we're in a weakening trending environment. The ADX is going down and it's below its moving average. But we're still positive because the green line is above the red line, even though the green line did decline and the red line went up slightly. But we're still positive for the time being. The Erin indicator, which measures buyers in green and sellers in red, when it takes the difference between the two, we're still getting a very high reading with this indicator. So that's still quite positive. The mass index is not generating a signal right now. We're far away from the red dashed line and the blue line here. Then looking at some other charts, I was watching this dashed pivot point up here. That could have been acting as some overhead resistance for the S&P, but we really didn't test that as we were going throughout the week here. This is a daily chart. We're still looking pretty solid though. We're above the 50-day moving average. We're above the 200-day moving average. Everything is still going up, but we're still seeing well below average volume here. So when you look at the Keller market model, we're positive across the board with the S&P, but we're negative in the short term with the mid caps and the small caps, where the NASDAQ 100 is doing rather well. Stocks are looking good across the board, where we have bonds based on price negative in the short and intermediate term. Commodities are negative in the long term, and the dollar is still negative in the long term. And this is a trend channel going back to 2009, still coming up to the upper end of this trend channel. That's positive. And I stopped showing this in the daily video because it's like, what new can I say until something happens? But these are the pivot points, and we're well above this R2 level. We had a slight down week. That's why you see the red bar. But this is still looking pretty solid for the year 2024. If you take out, well, you have to include it, but we have the pullback last spring and then the pullback last summer, but still looking good when you take a bigger picture look at this. So based on the trend, we still have the S&P going up, even though it was down this week. The red line still going up, the 50-week moving average, and prices above the red line. We use a moving average crossover, still above the blue line and above the red line, and everything is still going up. And we're getting extreme negative now with the McClellan oscillator. And what's interesting about this, we're also getting an extreme negative reading on the daily charts. So if this can get down to the point where it actually stops going down and starts to go up, that could be positive on the daily side as well as here on the weekly side. The Swenlin trending oscillator, we did drop below zero based on price and volume, as we saw a bit of a pullback here. And the summation index, after getting really extreme positive, is coming down because the the McClellan oscillator is down. And we also saw a bit of a decline based on volume, but we're still well above zero with both. So we're still looking positive here. But the fact that they're both declining is a little bit of a concern. And the bullish percent index, seeing the same thing on the daily chart here. It's positive and was really positive, but the context now is that the BPI is coming down, and that could be a concern. And this is a different kind of indicator. This isn't moving average base. This isn't an oscillator. This measures the point and figure buy or sell signals inside of the S&P that were really strong, and now we're seeing this coming down. And that we just want to keep an eye on that. As far as momentum, we're still trying to turn back up with the PMO, where we're turning more negative across the board on the daily charts, except for our very long-term oscillator. But we declined here based on price and volume, but we're still above zero. And not getting an extreme reading right now with the percent B. When we look at the Bollinger Bands, we're still above the midpoint. So this is still positive. And the chicken money flow, seeing a little bit of an improvement on the daily charts until Friday's session. Seeing a little bit of weakness here. If the red line rolls over and the histogram, which are the green bars, continue to go down, that would be more negative. But for right now, this is still positive. And starting to get extreme negative here with the PMOs inside of the S&P that are rising. We're also seeing a decline with the buy signals, and after being extreme positive, the PMOs that are above zero are starting to decline. So this is a little bit of a concern to us, but it's normally what we see during profit taking for right now. We're still going up in the short term with the slope oscillator and the TSI. We have the MACD, the PMO, and the PPO. Those are intermediate term. They're still going up, and we're trying to turn up with the TRIX, which is a long-term oscillator. We're still below and trying to cross above a declining moving average with the KST. And this is still negative on the daily charts, but we're turning more negative on the daily charts across the board. This never really did turn positive on the daily charts. And after coming up to this red line, the chicken oscillator saw a little bit of a decline. That could be somewhat of a concern longer term we want to keep an eye on. And we declined, but we're still positive with the force index since it's green, declining after getting a really high reading here with the money flow. But we're still above 50, but the context is this is going down. And after being extreme positive with the Stochk RSI, we're now coming down from that. The Williams percent R came down, but is still extreme positive. The RSI, we're still looking good on the daily charts. We're above 50 with both an RSI based on 9 days and then another one based on 14 days. This is a 14-week version. So we're still looking good on a momentum basis with the RSI. The ultimate oscillator starting to get extreme positive now. That's just showing good longer-term momentum. And since we had the down week from a week ago, the rate of change ended up being negative. The vortex is still looking positive. We'd like the green line to be going up, but the fact that it's still above the red line makes it positive. And the rate of change coming down a little bit here, still above this red line, but looking positive, although we are coming down a bit. And we're just about ready here on the special K. This is a long-term oscillator. We're getting very close to crossing positive on the weekly chart, where we've been positive for quite a while now on the daily chart. The Copic curve starting to turn negative on the daily charts, where we're still positive here on the weekly chart. And we didn't, even with the pullback, come down to any of these moving averages or Fibonacci retracement levels. So really nothing happened here. So we're still looking positive on the long term when we look at the Heikin Ashi based on a trend basis. And we're still looking positive with the Kegi chart. The Renko chart has open blocks, that's positive. And the 3-line break continues to be positive as well. So even though we're seeing a little mixed signals on the daily charts, we're still looking solid here on the weekly charts for the time being. And we're still above zero with our 14-week ease of movement indicator. No new X's or O's were drawn with the point and figure chart. This is still looking pretty solid overall. We're still working off of a triple top breakout that was generated on September 16th. And we're pretty much flat, but still looking okay with our long-term momentum. A bit of a decline with the intermediate term and a decline here with the short-term momentum. And coming up around the first part of November, that will be when we see a new 50-day cycle. I use this as more entertainment because there's sometimes when it really picks something out, other times when the market pretty much ignored this. And I've tried different lengths of cycles, and usually they work in hindsight, but they don't tend to work in foresight. So I don't use them all that much. We've gone from positive to neutral with the Elder's Impulse system here on the weekly chart, but we're still positive with the parabolic SAR. And even with the weakness that we've seen this past week on the daily charts, we're still positive with the parabolic SAR as well. Now, looking at the broad market, where the S&P just a week ago set an all-time high, we're just set a recent all-time high with the mid caps, and the small caps are still just range bound. They came up to the high end of their range, and now they're going back down. But when you look at the Dow, which set an all-time high a week ago, it was down this week, but still above its 13-week moving average. The NASDAQ looking pretty good here as well. It was actually up on the week. The NASDAQ 100 up, not by very much, but it was still positive and above the moving average here. And here's another look at the QQQs, which is the NASDAQ 100, just looking pretty solid for the time being. We want to see if there's more follow-through with this. The small caps just coming up into the high end of their range and then dropping back down, which seems to be the story of 2024. The mid caps coming off of an all-time high, pulling back, but still above the 13-week moving average. The Wilshire recently set an all-time high, saw a bit of profit taking this past week. The NYSE also a recent all-time high, but saw some profit taking as well. The biggest software company still looking pretty solid and in an uptrend, and they were actually up on the week. All stocks, which looks at U.S. stocks and international stocks, we did see a bit of a decline, but still above an advancing moving average. The FANG index is not setting all-time highs, not down all that much this past week, but still looking positive. ARC, it was down, and it continues to be in a downtrend since the blue line is below the red line, and pretty much chopping sideways these days. The KBW Bank Index, looking really solid, been really solid in 2024. Coming off of a recent extreme positive reading when we look at the RSI, but the momentum continues to be positive here, even though they were down almost 1.5% for the week. And here we are in October, where we tend to do a lot better than September, even though September was not that bad of a month this year. And then November and December tend to be more positive. So we can get through this election, we're looking at the potential of it being more positive seasonality. We'll just see if the market takes advantage of that. The Dow coming off of a recent all-time high, but then saw some profit taking this week. This was mainly earnings reports driven. Transports just continue to chop sideways. Utilities still looking strong, but saw some profit taking this week. We look at commodities, which are still in a downtrend, but they bounced off of their shorter moving average and they're starting to bounce back up. They were up on the week. Oil, we're watching this mainly for geopolitical reasons, still hanging out around that $70 level. They came in at 71.78. The dollar, after coming down to 100, is really going up solid now, even though it's still in a downtrend. We have the blue moving average below the red, and we're still negative on the daily chart, but it's been showing some real strength lately. Gold just coming off of setting another new all-time high. Silver also looking pretty well, even though it was slightly down on the week. Copper is looking good as the economy still tends to look pretty good. And then we look at the price of bonds. This is the total bond ETF. This is not yields, this is the price, where we're actually falling a little bit below the 13-week moving average here. That's a little bit of a concern. We want bond prices to go up because then that means interest rates are going down. But we're still looking okay here. When we look at a monthly chart of the stock to bond ratio, stocks are really outperforming bonds. And this is a daily chart of the yields where we really were coming down. Now we're starting to go back up. We'll see where interest rates go from here. Typically, interest rates going up puts pressure on stocks. Interest rates coming down can be more friendly for stocks. This is a weekly chart looking internationally. We have the US and UK rates the highest, and then German rates, all of these were up on the week. And even Japanese rates were up as well. That's the red line. Looking at the intermarket analysis chart, we still have gold doing the best, followed by stocks going back to the beginning of the year. And then oil saw a bit of a bounce up as oil was going back up slightly to geopolitical. It was in the 60s, now it's in the 70s. Where the green, that's the dollar. We still have the price of bonds going back to being negative year to date. Then we look at a ratio between the NASDAQ 100 and the S&P. The NASDAQ 100 actually blipped up a little bit here, but it's still in a downtrend. Now, both of these are doing well. The S&P is just coming off of an all-time high. The NASDAQ set its high last summer. If this continues to go back up and we cross back with the moving average, that would be even more positive for the market. We look at the S&P 100 and see how it is outperforming the rest of the S&P 500. And those are the biggest stocks that make up the S&P 500. Growth to value, this is what we want to see if we're more positive. We're still seeing growth outperforming value. And gold is really outperforming the dollar. Even though the dollar's been going up, the gold has been going up even more, and that's why this ratio is going back up. Bonds continue to underperform stocks when you look at them based on price. And then you compare gold to the S&P, well, this went up a little bit. It's really been choppy around. Even though gold's been setting all-time highs, well, we have the S&P coming off of recent all-time highs too. So they're both really doing well right now, but gold's, at least lately, been outperforming. We look at the low volatility stocks and compare it with the S&P, continuing to underperform. Now, longer term, we're really getting close to a golden cross here, which means the low volatility stocks may be in an uptrend compared to the S&P. If this can continue to fall, we may avoid seeing that cross. And this going down is actually more positive for the market. Discretionary to staples. Discretionary had a pretty good week, even though they're in a downtrend when compared to staples. Energy is still in a downtrend when we compare it to tech. And small caps against the tech sector. This is going down. That means the tech sector is continuing to outperform small caps. Then some long-term charts. This is the NYSE breadth thrust. Did see a bit of a pullback here. We're still working off of the signal from October 2022, and that's kind of indefinitely on the books going forward. Where the ZWAG NYSE breadth thrust, these signals usually last a year. Well, we saw a little bit of a decline here, but it actually bounced up just a little bit this past week. Longer term, we're still looking good. This is an S&P weekly chart. Going back to 1987, we're still well above this trend line. This is a further blow up of that same chart, showing how we're really far away from that right now. The Zohorchak, this is another method that produces buy or sell signals. When we're all the way at the top, that means it's a full-on buy signal, and we've been that way for months now. The NASDAQ 100 weekly chart, we're still above this trend line, so that's still looking solid there. We look at the NASDAQ 100 and do a ratio with the Dow. We're still going above this red line here, well above where the perma bears said everything would start to fall apart. And then we look at the QQQs, the NASDAQ 100, so small caps, also seeing how the QQQs are outperforming. We're going back above this blue line. That's positive for the market. Then we look at new highs and new lows on the NYSE, coming down a little bit here, but we're still well above zero with this reading. And we look at the S&P 500, also declining a little bit here with the 50-day moving average of the new highs minus the new lows, but still well above zero. And the cumulative new highs, new lows for the NASDAQ, getting a positive reading just barely here on the daily version, where we're starting to go back up here with the longer term chart. And we want to keep an eye on the 3-month yield. It's kind of settled right around this level for right now. Just in case something really weird happens, like happened back in 2007 going into 2008, we saw a real drop. Well, this has been dropping lately, but we have to know the context. Was this dropping back in 2007? This was when all kinds of bad news was hitting the market. Now it seems to be that inflation is actually coming down. So we're just watching this and we want to know the context of why this is declining. Then just an update here. I stopped showing this chart in the daily videos. I'll just show it here in the weekly video. The Hindenburg-Omen, we do have a confirmed signal here. We see 2 spikes. The first one was generated on September 5th, where the confirmed spike was on September 12th. And this kind of goes on for a while. And we'll see if we get any more spikes up here for more confirmations. But the reason why I bring this up is we saw a bunch of these spikes right before the COVID crash and right at the end of 2021. So that's why we want to pay attention to this and see if any more spikes come up. So far, we haven't seen any more. Seasonality, I got a number of charts to go through here. October is up 60% of the time and with an average return of 1%. November is a little better, up 68% of the time with a return of 1.5%. And then we're kind of finishing out this time in October. We should have seen some potential weak seasonality here that we really haven't seen all that much. But then we're potentially coming into a time of positive seasonality according to this chart. So we look at October, which tends to be positive, where November tends to be even better. This is going back on a monthly basis to 1950. And we look at the world here. This is October where we're positive, and then we compare it to November, where November tends to do even better. And we're finally finishing up this September, October time. We didn't really see any of the weakness that usually happens right now. We're wondering, are we going to see any of the strength that historically has happened in November and into December? Your so-called Santa Claus rally. And then we look at the first half. We're done with the first half of October, which tends to be strong. We're coming up to the end of the second half of October. Now we go into the first part of November, which tends to be a little bit weaker than the second part. And next week when I show this, I'll change these boxes around. And then here's September, October, where it tends to not do all that well, but then November tends to look more positive. We don't know if that's what's actually going to happen. And we use these charts as just a guide. We look at our other charts. I don't use these to make decisions. I just use them just for informational purposes. And then we'll finally be beyond this too, the September and October doldrums here, which didn't really seem to happen this year. But then we typically will see things turning more positive in November into December. And here's the August through October time, which tends to be negative, where September through November tends to be positive. And then during an election year, we tend to see things more negative in October, but we see things more positive in November. Yeah, go figure. And then we're getting into the fourth quarter. Take the whole quarter together, which tends to be one of the better quarters, if not the best quarter of the year. And then this is a new chart here. This is going back to 1950. These are during election years, and we tend to see positive returns, especially when we get out of October and into November. Things historically have looked better. We're wondering if that's what's going to happen this time. If something crazy happens with the election, then we'll have to see just how the market reacts to that. And then looking next week, I'll have the November version here. We have a 50-50 chance in October. We're up 9 out of 18 times, down 9 out of 18 times with the return of minus 0.9%. So thank you. I hope you have a great weekend, and I will talk to you in the next video.